If the Fed slows down the rate of dollar printing, which is called tapering, like they've indicated that they will announce at their next meeting, what this usually does is this slows inflation, it makes the stock market drop, and it makes interest rates of all types, including mortgage interest rates, go higher. Yeah, the mere announcement of this makes these things happen. Hi, I'm Keith Weinhold. This is Get Rich Education. Today we're talking about predictions on the future of interest rates, inflation, and the dollar, and I'm talking with Brien Lundin. Brien runs Jefferson Financial. He runs the Gold Newsletter. He also runs the New Orleans Investment Conference. It is the longest running investment conference, not just in the United States, but the world. And it's had illustrious speakers over the years like Margaret Thatcher and Milton Friedman. And at this year's New Orleans Investment Conference, which I'm going to be attending, you're going to see financial luminaries speak, including Ron Paul and Peter Schiff and a whole lot of your financial heroes. So today you're learning about macroeconomics and how that relates to your personal finance. And we are talking about real estate investing, but we're also talking about other asset classes as inflation, interest rates, and the dollar applies to cryptocurrency and even stocks and gold and some other asset classes. Brien is a gold guy, and I'm going to flat out ask him, why hasn't the gold price risen? It's stayed in this range of $1,700 to $1,900 per ounce all year. But if nothing else, stick around until the end of this video because I'll give you the link and you can meet me in person in just a few weeks here in New Orleans. It's the future of interest rates, inflation, and the dollar with Brien Lundin. I'd like to welcome in the host of the longest running investment conference in the entire world, the prestigious New Orleans Investment Conference. It takes place next month in New Orleans in just a few weeks here. I will be there. He's also the executive director of the Gold Newsletter. It's good to have you back on GRE. Welcome in, Brien Lundin.
Great to be with you again, Keith. Thank you so much for the opportunity.
Yeah, I'm really looking forward to coming back to next month's conference. You've had such prestigious speakers there over the years, from Margaret Thatcher to Steve Forbes to Milton Friedman, Alan Greenspan, Gerald Ford have been there. So before we're done here, I want to hear who this year's speakers are going to be. But we are real estate investors here predominantly on this show. So before we pivot and talk about some bigger macroeconomic things, Brien, I'd just be very interested in your big picture view on real estate. In a sense, we're really at a lot of extremes in the residential market anywhere. We've got higher prices, lower interest rates, historically low supply, and now this year rents are spiking. So from your big picture view, how do you evaluate the real estate climate today?
Well, it's important to remember what created that climate, and that's been easy money, ultra low, even negative on a real inflation adjusted basis, interest rates. And, you know, the Fed is starting to talk about when it will start rate hikes and trying to normalize that, when it will start tapering back, quantitative easing, et cetera. And my thesis, my operating thesis is that don't worry, we're not going to get interest rates rising to any appreciable amount. We may not even see the Fed begin to taper at all because they can't. They're really in a trick box right now. So the good times, I believe, will continue to roll. And of course, there's always going to be wiggles along the line on the uptrend as we go ahead. But the environment that has been conducive for a buoyant real estate market in general, and of course, it all boils down to location, but the environment that's been conducive for that will continue because it has to continue. The Fed is, given the size of the federal debt, et cetera, and for many other reasons, the Fed cannot tighten monetary policy appreciably, and therefore it's going to be a real tailwind for real estate going forward.
Okay, so just some translation here. A Fed tapering would mean a tightening of policy somewhat. So we talk about a Fed taper. Currently, the Fed is buying $120 billion a month of treasuries and mortgage-backed securities, which has the effect of pumping liquidity or dollars into the market. And for example, a tapering, we'd be taking those purchases from $120 billion a month down to, say, $80 billion a month for a few months, and then $40 billion a month for a few months. That's what you're saying they cannot do. And interest rates, in your opinion, are going to continue to be persistently low over the intermediate term, at least here?
Yeah. Tightening, normalization of monetary policy will take those two steps. First tapering, then interest rate hikes, if they can get very far down their road. And also there's kind of a duopoly on why they can't do this or get very far down their road. One is the federal debt. They can't raise interest rates because the cost of servicing that debt burden would basically crush the federal budget and overwhelm any other spending. And number two, they've created this financial house of cards, primarily pumping up asset prices in the stock market, as well as bonds and real estate as well, trying to really float the economy higher on an ocean of liquidity. They can't withdraw that liquidity at this point because these asset classes are dependent upon it. So they'll if they try to throttle back that support, then these markets will throw a hissy fit and tell the Fed, no, no, you can't do that, and they will take those marching orders, as it were. So that does create other issues, other problems. But the bottom line at this point is that they can't afford to let these markets decline to any great degree, because it would threaten to bring the economy into a very deep recession, and they're not going to let that happen.
Now, isn't the Fed between a rock and a hard place? Because inflation and interest rates are positively correlated. Generally, when you have higher inflation, the tool that the Fed uses is higher interest rates to cool this overheating economy and tamp down on inflation. But with inflation, at least on a CPI basis, at 5%, on a PPI basis, running higher than that lately, the Fed can't raise interest rates to go ahead and get on top of that. I mean, are they in a rock and a hard place? Because their classic tool for controlling inflation, interest rates, is what you're telling us that they really can't raise? Or do you feel that inflation is transitory and will come down? What are they going to do?
Yeah, I don't feel inflation is transitory. I think there are a lot of factors, a lot of drivers for inflation that are deeply, deeply rooted, primarily in commodities, really supply constraints, rising demand curves for a lot of commodities that would take really a decade or more of really high prices to alleviate. So that's going to keep on. Inflation is here, at least higher inflation. We may not see inflation in the 5 to 6% range from the CPI like we've seen over the last couple of months, but it will be far above the Fed's 2% target. So that's one issue. Now, what they can do on interest rates, they can raise interest rates, but they have to keep interest rates below or well behind the rate of inflation. So they can't really snuff it out. So inflation is running at, say, 5% annually. They really can't raise rates more than, say, 2 or 3%, because they need significantly negative real rates, rates that are negative, yields that are negative, adjusted for inflation. So they need that to be in the 1 to 2% negative real rate range going forward. Otherwise, you get those pressures on cost pressures on servicing the debt. For real estate investors, that's fine. You can have 3, 4, even 5% interest rates. I mean, that's typically normal or even low for what's normal over time. You can have interest rates at those levels if the inflation rate, if the value of the underlying assets is increasing at a significantly higher rate than those interest rates. So that's why I say for real estate, the economic, the macro situation is going to be conducive, in my view, for as far as the eye can see.
Yeah, it's interesting, Brien. Consumers don't want to see price inflation, as they see everything from dish detergent to avocados go up in price, and the purchasing power of their dollar diminishes. But something that a gold person like you and a real estate person like me have in common is, in a sense, we kind of cheerlead against the dollar, because real estate investors tie up a lot of long-term fixed interest rate debt, and then the gold price goes up in dollars, gold being that classic hedge against dollars. So it's sort of interesting that we often find ourselves cheerleading against this in a way, if we've structured ourselves and aligned our interests with what we think that the Fed is going to do, and effectively create more dollars and debase each individual dollar. And, last month we had quite the milestone when gold and dollar intersected. sec, because last month on August 15th, of course, we had the 50th anniversary of President Richard Nixon depegging the dollar from gold, which really opened up a whole new slew of inflationary pressures that have really been mounting for 5 decades now. And, part of that Nixon speech that a lot of people don't talk about, Brien, is that Richard Nixon, in that speech 50 years ago, said that the dollar is going to be worth just as much tomorrow as it is today. Well, that's certainly not true. He had to say that to assuage the public. And we know that on a CPI basis, if you want to believe the CPI, which a lot of people has understated, the dollar has lost about 85% of its purchasing power over the last 50 years. So what are your thoughts there and the future direction of the dollar, Brien?
Well, it depends on how you measure it. And I'm glad you brought up that Nixon closing the gold window and depegging the dollar in gold in August 15th, 1971, because that's really when Gold Newsletter, our flagship publication, was launched by my late business partner and mentor, Jim Blanchard. He heard Nixon's speech. He knew that Nixon, another thing he said was that this was a temporary measure. And, going on 50 years, over 50 years, we're still waiting for it to be rescinded. But that's when he decided to launch Gold Newsletter to advocate for the return of gold ownership, legal gold ownership to the American citizens. Back then, you couldn't legally own gold. It was up there with heroin and plutonium. You couldn't own it. The government didn't want you to have that protection against what was to come. Jim saw what was to come, and that was the rapid devaluation of the dollar. And then you have to look at how you measure the dollar. You look at the dollar index, you have to realize that that's really the dollar's value against other fiat trade currencies. So it really doesn't value where the dollar is. The real judge of the dollar is what you also mentioned, its purchasing power over time. And the best gauge for that is not just the CPI, but the gold price. So when gold's going up, the value of the dollar relative to gold is going down. And gold its primary function, again, is as insurance against the dollar losing that purchasing power over time. It isn't a direct one-to-one correlation with inflation or the loss in the dollar's purchasing power. Sometimes people don't want to own gold or don't feel the need to own gold because they think things are just hunky-dory as they are, inflation's low, et cetera. But when they start to get worried about where the purchasing power of the dollar and whatever their currency is, they buy gold because it is the age-old hedge and insurance against that depreciation and purchasing power. And that's when gold plays catch up and really its value relative to the currency rises. That's what we're seeing right now. And that's what I think we're going to see over the next 5 years or so, because these trends are kind of coming to a head. The dollar has to be depreciated. Every fiat currency has to be depreciated because the cost of the debts have risen so highly. And gold's going to be the main beneficiary of that macro trend. It's going to be the primary insurance against the effects of that macro trend.
Robert Kiyosaki was here with us last month discussing that 50th anniversary of the dollar being depegged from gold, because to people in the finance world, that's a pretty significant event, but most of the public really isn't even that aware of this or understand the value of gold. And gold is one of the very few assets that's had sustainable value for millennia. You just can't say that about very many things. In fact, in the event of a crisis economically, I think it protects people from getting wiped out better than just about anything that I can think of. So in a sense, it's a great money insurance or currency insurance policy is one way that I like to think about it, Brien. And some people think of it as an investment. Some other people think of it as more of a hedge. And Brien, I told my audience that I made a substantial investment in gold this year for a few reasons. Number one is more inflationary pressures. And number two is, Brien, in my opinion, gold has not had this great price run up like almost every other asset seems to have had, from stocks to real estate to cryptocurrency. So really, that's another reason that I wanted to buy gold. I feel like it's a pretty good value right now. Gold this year has generally been trading in a range between $1,700 and $1,900 an ounce. But maybe some wonder, Brien, and really me included, is Why isn't the gold price higher here where we printed massive dollars going back about a year and a half ago with what's happened with this exogenous shock in the economy? Why isn't the gold price higher?
Well, one thing we have to recognize is that gold did have a huge run from the early days of March when everything kind of cratered. And then it rebounded very quickly and had a tremendous run to the early days of August of last year. So the resulting correction has kind of been a digestion of that huge move higher. And we're still higher than where we were before the pandemic, significantly so. So what is gold telling us today? It predicted a lot of what we saw in the Fed policies, the Fed easy money policies that came in after the pandemic, and the fiscal spending that we're seeing right now. I think what gold is about to tell us are really a couple of things. That inflation is not transitory, it's here to stay. And two, that the Fed really can't do an awful lot about it right now and is going to remain powerless. If and when the markets realize that and start to try to factor that in, they're going to be buying gold hand over fist. And I think right now we're in that transition period where the markets, at least the professional investors that set the prices of gold, of stocks, of bonds, those investors are believing what the Fed is saying, that it will be transitory. And once the Fed is proven both wrong and impotent, then I think you're going to see a mad rush into inflation protection assets that would be gold, silver, all tangibles, and of course, real estate.
So, connecting the dots here, Brien, with higher inflation expected to persist and the Fed not having the ability to raise interest rates to tamp down on inflation, this can therefore increase the value of everything that's denominated in dollars, especially those classic assets, including things like gold.
Yeah, gold, collectibles, real estate, things like that. Now, there are ways, to actually make money on this macro trend. Of course, income producing real estate protects you by not only producing income, but the asset itself rises in that kind of an environment, typically on pace with inflation, or even more depending on where it is. Gold and silver are the classic monetary metals that protect against the depreciation of the currency and inflation. If you want to leverage that trend, then you can get into the trend specifically for gold and silver and other commodities. You can get into mining stocks. We cover a lot of those in particularly the junior mining stocks in Gold Newsletter. That's another really typical or classic way to leverage what you see as fundamental trends that are driving the prices of the metals higher.
Now, Brien, when I go to conferences and attend workshops in those conferences, including ones that you have at the New Orleans Investment Conference, often when there are some younger people who are in the audience at a gold workshop, one takeaway I get from them is they kind of start nodding their head like, yeah, maybe I should consider buying and owning gold. Like it's something they had just never even considered previously. So with that in mind, and you mentioned junior mining stocks and some other things, how do you recommend that one holds gold if they want to get a hold of some? Should they get sort of a derivative product like a stock, or is it better for them to physically stack Engelhard silver bars and Pamp Squeeze gold bars, either hidden around their home or in a safe deposit box? Or how do you recommend that one hold gold and precious metals?
Yeah, that's the first step I tell anybody. And as you know, over the last 8 or 9 years, I've gotten involved with a lot of the movers and shakers and thought leaders in the real estate markets. And therefore, I've been exposed to a lot of people who are new to the sector, but like you say, are getting it and understanding the real role of gold and want to get involved. So I tell them it can be very confusing. There's a lot of different ways, and within each method of investing, there's another spectrum of opportunities and risks as well. So step number one is get physical metals, not necessarily the paper derivatives, but get the physical metals and get them in your either your direct possession or close accessibility, not safe deposit boxes, because one of the things you're insuring against is bank closures and the like. Gold and silver get a bit of both. Silver moves more than gold percentage-wise in both directions. Important to realize that too. On the way down, it outperforms gold as well. So get a little bit of both. I like junk bags of silver. The old US silver coins are a great way to hold silver. It's kind of bulky, but it's small denomination, and they're just neat to look at. So I do like those as well. There's a report on our website on goldnewsletter.com that's free called The Investor's Guide to Gold and Silver. Goes into all the different areas, but get that physical metal holding first to ensure yourself against wealth destruction as the dollar's purchasing power depreciates. Then after that, then you can talk about investments. You can look into investments that would leverage that move, and mining stocks are one way to do that.
You, the listener and viewer here, might want to identify a nice spot in your backyard for digging a hole, if you will. And don't forget, in a few months, the ground is going to be freezing in wintertime, depending on where you live. So you might not be able to recover that. But yeah, so physically, then it doesn't have any counterparty risk. It's not a derivative. You're holding on to the real thing, real gold and silver. And Brien, I attended your prestigious New Orleans Investment Conference 3 times previously, 2014, 2017, and 2018. And I think one thing that's different this year is the growing role of cryptocurrency, especially Bitcoin, the biggest cryptocurrency by market cap. In fact, just this month, we saw El Salvador become the first nation in the world to make Bitcoin legal tender. And critics of cryptocurrency, I think chiefly they might say that cryptocurrency is not backed by anything, but yet supporters of cryptocurrencies like Bitcoin say, hey, this is money that's tailored to be used in the internet era, and there are only ever going to be 21 million Bitcoin, so it has a fixed supply, unlike dollars that can be and have been printed profligately. So what are your big picture thoughts with cryptocurrency today, Brien?
Yeah, I was just at another conference in Las Vegas earlier this week on a panel, Gold versus Crypto. And like all of the gold versus crypto panels that I've been on, it's been less of a us versus them, is kind of a kumbaya moment. Let's all hold hands and get out of the dollar into alternative investments and get out of the government's control. I think crypto is a worthy asset class. I think it's something people should look at and understand. There is a learning curve, but understand it. And I think it's something that's laudable in its goals and offers real advantages. I don't think you should own it to the exclusion of gold. And I think everyone should look at owning some crypto. The things that concern me about crypto are that many of its use advantages, or many of the original reasons to own crypto, like getting out of the government's purview, are being lessened by the crypto's desire to get under the regulatory umbrella of the SEC and the like, and being regulated, and the government paying attention to regulating them, the coins somewhat. So I think that's hurting it, and I think central bank digital currencies are going to take away some of the uses of crypto. So it's an evolving landscape right now, and it is speculative, and people are speculating in it. So it's something that I think people should look at owning, but they needed to educate themselves on it before they do so.
Yeah, but it's about embracing that commonality sometimes between crypto investors and gold investors and real estate investors that have long-term fixed interest rate debt. We're all interested in shorting the dollar. We're all basically making a bet that the dollar is going to go down in terms of purchasing power. Well, Brien, your New Orleans Investment Conference is prestigious. It is the longest running investment conference, not just in the United States, but in the world. There's just really a great feel of professional polish there. I always have an excellent time. New Orleans is a fun city. So tell us more about this year's New Orleans Investment Conference and some of the speakers that you're going to have.
Well, we have been dead set to have another in-person event. We were virtual last year, and by hook or by crook, we're going to be in person. And I was able to get my wish list, personal wish list of speakers to come. And it is going to be an extraordinary event. We've got Dr. Ron Paul, we've got Jim Grant, we've got Jim Rickards, Danielle DiMartino Booth, Jim Urio, Doug Casey, Rick Rule, Peter Schiff, Dave Collin, Grant Williams, Dominic Frisby, and the list goes on and on. George Gammon, Brent Johnson, Peter Bookbar, Mark Skousen, the real estate guys, on and on and on, dozens of the people, the very people that I think are the thought leaders today, who have the best insights, who can really bring value and give you a peek behind the curtain about what's really going on, really well thought out forecast of where the economy is going on, and specific ideas on what you need to do right now to protect yourself from the risks, which are extraordinary, and take advantage of the opportunities, which are equally extraordinary in this kind of an environment.
And for the attendee, I kind of think of three different activities that one can do. Principally, we're in sort of that main event hall where you have the big stage with some of the speakers that you mentioned. Additionally, one can go across the hallway over into the exhibit room where all the tables are and visit with those people. And then alternatively, there are those breakout sessions in the smaller rooms upstairs if you want to attend some of the particular topics that interest you, whether it's resource extraction or real estate or cryptocurrency or oil and gas or gold and silver or whatever it is.
Yeah, and one of the best resources at this conference, if not the best, are the other investors. Think about it. You're traveling to New Orleans, a destination in itself, and you're surrounding yourself by hundreds of investors who have the same goals, who not just don't necessarily think similarly, but have the right approach toward investments. So you're getting new ideas, you're getting new opportunities. All of these people have self-identified as being very smart, very curious, and very successful just by the fact that they're at this event. So the intellectual energy, the ambiance in the halls, that's what we were missing with the virtual event last year. And that's why we were so dead set to have the event this year back in person, so we get that kind of networking effect that we were missing before. And it's so special, not just to these kinds of events, but also to the New Orleans conference, because it is unique amongst all conferences out there. It does have a certain entrepreneurial, more libertarian feel to it. And that's the kind of people that show up there, and they're worthy of talking with and listening to. And, and they want to hear what you have to say as well.
It's October 19th to 22nd in New Orleans, Louisiana. It's the New Orleans Investment Conference, a 4-day long conference culminating with Dr. Ron Paul speaking on the final day. If you want to get signed up, hey, we'll get to meet in person as well. You can do that at getricheducation.com/events. Brien Lundin, it's been so good catching up with the state of the economy. Thanks so much for coming back onto the show.
Great, Keith. It's been a wonderful experience as usual. Please, anytime, and thank you for the opportunity.